The Union Gas company background is pretty straightforward. Okay? It is a established provider of fuel products, okay, in Singapore with over 40 years of operating track record. They have these three key businesses, which comprise of their retail LPG business, which they will sell to the domestic households. They serve more than 190,000 domestic households in Singapore. And as for the CNG and diesel business, right, Union Gas sell and distribute these two products, okay, from a fuel station at 50 Old Toh Tuck Road. Yeah. Okay, but what is more interesting, right, is actually their revenue split. Okay, if you dive into the latest financial results or the annual report, right, financial year 2018, they earn a revenue of 56.36 million. And come FY 2019, right, it actually increased around 40% to $78.8 million. And if you were to take a look at the revenue split, right, the revenue from retail LPG, which is the domestic portion, right, actually increased by 6.8% from 28.5. If you can see here, it's 28.5 million, okay, in FY 2018 to 30.45 million in the next year. So that means even though it increased, right, their revenue share actually decreased from 50% to 39%. And what is the major component, right, of this shift is because of their retail LPG commercial, whereby it increased 300% on a year-to-year basis from $5.58 million to $22.43 million. You look at the dark blue portion, okay, 5.58 to 22.43. So there's a 300% increase. And that is mainly due to the acquisition of UGas that expanded the LPG supply to eating houses, coffee shops, and the commercial central kitchens. And because of that, right, the revenue share increased from 10% to 28% for FY 2019. And last but not least, I just touch on the third major split of the revenue, which is diesel business. So it's slightly increased from 20.1 million to around 24 million. So that is also a notable increase of 19.1% due to the increase in diesel sales volume. Okay, for now we will go on to the financials portion. Okay. First, we will look at the fact sheet. Okay, here you go to the Web Pro and go to the fact sheet. And if I scroll down, right, yeah, to the portion over here, this fact sheet, okay, we so-called the Smiley Grid, is our proprietary financial analysis tool, okay, unique to share investor that provides a snapshot of the overall financial health of the company. And in this case, right, you can see from the legend here, okay, excellent and good. So the green and the dark green smiley faces, and Union Gas happen to have all these green faces. Just let me touch on a few. Okay, one of it is the revenue growth. It has increased revenue in the last 2 consecutive years. There's a one-liner where you can read it off the bottom. Okay, then we have profit growth also, dividend payout, okay, which I will touch on more in depth later. Free cash flow positive, okay, and increasing over the last 3 years. Gross profit margin 20 to 40% for 3 years. Same thing for ROA and ROE. So in a nutshell, right, this is a pretty good overview, okay, of Union Gas. That all the fundamentals are portraying a strong picture of the company. Okay, Then let us move on to the revenue and profits. Okay, Union Gas is listed only in 2017, so we can only look at the past 3 years of results. But from here, right, we can already see a good trend that's forming. You can see that the revenue, okay, the blue color bar, $39.1 million to 78.8, around $79 million, okay, in 2019. And for profits, okay, let me take away this revenue. Okay, you can straight away see here, let me just, a very clear trend. Okay, the profits is also increasing 3.4 to 6.4 and then to $8.4 million. If you want to know where it is, it's profit of after tax over here. Same thing, a profitable company doesn't mean it's free cash flow positive. So with that, right, let me check on the free cash flow. So you can see the free cash flow is in line with the increased revenue and profits as well, from $1.5 million to 7.6 and $10.8 million for 2019. Yeah, so ever since their listing, right, in 2017, they have been consistently growing their revenue, profits, and free cash flow. Okay, with that, let me also dive into the dividend trends. Okay, this is a very how do I say it? This is for because Union Gas is actually a small cap stock, and people always think that, oh, a small cap stock means you cannot have a stable kind of or attractive dividend yield. But in the case of Union Gas, right, over here you can see, okay, the blue color bar, the earnings per share has been increasing, and same goes for the green color bar, which is the gross dividend per share. So you can see dividend in 2017 is 1 cent to 1.2, which is 20% increase, and then to 1.85%. So 1.85 you compare to 1 is around 85% more just across 3 years. And let me scroll down. You can see from here is a more clearer picture of the dividend history table that currently taking the current share price divided by the dividends per share, you'll get around a 6.3% dividend yield. And the payout ratio, right? Because usually if you want to have a sustainable dividends, you need to look at the payout ratio, is actually maintained at around 50% throughout the 3 years as well. Okay, next up, let me go to the ownership. Okay, in case you are not aware, right, the chairman or the boss of Union Gas is actually the boss of Transcap as well. So Mr. Teo Kiang Ang, right, actually owns Transcap as well, and he's planning to do a listing for Transcap, but it hasn't materialized yet. And as of us, this pie chart, right? Okay, currently he owns a 32.3%. Okay, and the parent company owns 12.6%. The CEO of Union Gas, Mr. Teo Hap Piang, right? Okay, owns 11.07%. And on top of that, right, you can see that actually you can see a lot of the Teo family inside as well. So these are all the so-called the sons and the daughters of the chairman, and they each own around a 3 to 4% stake, whereas the CEO himself owns a 11% stake because he is the one that is directly involved in all the business operations. And in total, right, if you add up all this, right, the Teo family actually owns around 73% ownership which is pretty, we can say that it's well aligned with shareholders. Okay, and then let us go back to take a look at their balance sheet as well. So balance sheet, let me just go to this financial ratios portion. Okay, if you look at the total debt to equity, right, it's manageable at only 0.06 times for financial year 2019. And if you look at the net debt, okay, because their cash is more than the debt, so their net debt to equity is practically zero. And interest coverage, okay, they can cover their interest payments 128 times with just their net profits in 2019. So in short, right, they have a very rock solid balance sheet. Okay, and okay, then now let's move on to the valuation portion. Okay, now that we check that they have increased revenue, profits, dividend yield is attractive. Okay, payout ratio is manageable, ownership is strong, balance sheet is also strong. Okay, we dive into their valuation as well. Okay, and you can see, even though their revenue and profits have been on the uptrend, right, their P ratio, because of their share price that is has been remain constant. Okay, their P ratio has actually came down from 13 times in 2017 to around 6.7 times for financial year 2019. Okay, and okay, with that, I also want to do a quick so-called intrinsic value calculation for Union Gas. Okay, given that just now I look at the free cash flow, um, they have been churning out free cash flow on and increasing every year, right? I'm going to use the discounted cash flow model. Okay, this free cash flow per share is automatically part from the data that we have inside WebPro. Okay, then for the free cash flow growth rate, um, to be more conservative, okay, I will just park it at 5%. Even though just now we see that their free cash flow actually went from 1.5 million to around 10 million in 3 years. But when it comes to valuation wise, you may say that, okay, I want to be more conservative, then I'll just put a 5% growth rate. Okay, years on growth, assuming that it can continue to grow for 10 years, discount rate, because it is a more smaller cap company, which entails to a higher risk. And although the business model is easy to understand, many people may think that, okay, nowadays we are moving to gas pipe and things like that. So I will have a higher discount rate of 10%. So this is my also so-called required rate of return. That means if I invest in Union Gas and I want to be compensated for more of the risk, right, I can put a higher discount rate. Okay, then we go on to the terminal growth rate. If you think that okay, this company can survive after 10 years, still got they will be still selling fuel products and things like that, you can include the terminal growth rate. But at the same time, for me to be more conservative, I will just put a 0 here. Okay, so 0 terminal growth rate. That means I assume, right, after the 10 years of 5% growth, the company is not going to grow anymore. 0% growth after the 10 years period. And I click on calculate, I will get a intrinsic value of around 67 cents. And based on the current share price of 29.5 cents, right? You will get around a margin of safety of 55%. But that being said, right, okay, when it comes to valuation model and things like that, these are all based on the personal assumptions, so you should still also do your own research on this. Okay, then with that, I'm done with the valuation portion. And now let's move on to the growth prospects. Okay, so Union Gas, right, their growth prospects are pretty straightforward. Okay, first one is that they intend to increase their distribution network through asset acquisitions. And what do I mean by asset acquisitions, right, is the domestic customer relationships from those smaller players. So one example is whereby they acquired this SAM gas supply, okay, for 2.4 million on 20 March 2018. And the CEO actually said in the SGX interview, right, in recent years, there have been gradual attrition of smaller players in the retail LPG segment due to increased operating costs, stricter regulations, and higher customer expectations. And that, right, presents Union Gas with the opportunity to acquire or partner smaller dealers to enlarge their market share going forward. Okay, so that's the first point. That means they want to buy over those smaller players. Okay, second portion is as mentioned, right, in the revenue split, their commercial segment actually jumped 300%. And they are going to further further expansion, okay, into the commercial and industrial segments. Okay. Third point is their potential acquisition of the parent company LPG businesses. Okay, if you have been following the news, right, Union Gas actually announced on 17 June that they plan to buy the LPG businesses from their substantial shareholder and parent company, Union Energy Corporation. And this will allow the firm to own a holistic integrated supply chain and acquire an enlarged base of customers. Okay, let me just Google, okay, for it. Yes, okay, so this is the one. If you want, you can just Google and check it out. Yeah. There is the other link. Yeah, this one, okay. So they, as of June 17, they announced that they are going to buy the the businesses from their parent company. So in short, right, they will be even a bigger player going forward. Okay, if you want, you can read it over here. Just Google for it. Yeah. Okay. So to sum up, right, Union Gas, the overall picture. Okay, the financials. We have a stellar financial track record as seen from our proprietary Smiley Grid. Okay, 3 years of increasing revenue, profit, and free cash flow. Around 6.3. Yeah, okay, because the share price have moved up since I done the slides. So 6.3% dividend yield, payout ratio around 50%. The Teal family owns a collective 73%, and the CEO himself owns 11%. Pristine balance sheet. The Valuation wise, it has the lowest P ratio since the 2017 listing. I've calculated based on my own assumptions, okay, the intrinsic value to be around 67 cents. Growth prospects, um, we have the further expansion of steady growth, okay, in the retail LPG commercial, the expansion through the consolidation of smaller players, and also the potential acquisition of their parent company business. Okay, the one major risk that I wish to highlight, right, is that there may be a shift of the trend towards gas pipe. That means you know going forward, many people with new BTOs and all that, they are all using gas pipes, which is from city gas itself. Yeah, so that may then the demand of the union gas retail LPG domestic going forward. So investors will have to take note of this and then see whether the increase from the commercial segment will actually, compensate for this drop in the future. Okay, that comes to the end of our first talk. Okay, for Empire, you can see that it's coffee, snacks, frozen foods, and snack foods. So basically, their products right include a wide variety of beverages, coffee mixes, frozen foods, and they also sell potato crisps as well. Um, but to note, right, they actually have a flagship popular brand called Mac Coffee. Okay, there's nothing to do with McDonald coffee. It's their brand is called Mac Coffee, MAC Coffee. Okay, which has been consistently ranked as the leading 3-in-1 instant coffee brand in the core market of Russia, Ukraine, and Vietnam. So later you can Google to take a look. Yeah, they have a lot of marketing surrounding this Mac Coffee. Okay, then their products, right? Their wide variety of products are exported to over 50 countries from 7 manufacturing facilities in Malaysia, India, Vietnam, Russia, and Ukraine. Okay, then with that, let us dive into their financials. Okay, let me search for Empire. Okay, if we were to look at their fact sheet, right, over here. For Empire, you can see from here is different from Union Gas. Union Gas actually has all the pretty good or excellent smiley faces. Food Empire actually has this three so-called be alert signals. So naturally, when you look at the financial analysis tool over here, okay, you can look at their bright green, which is the increased revenue over past 4 years, profit, dividend increasing, okay, good gross margins, ROE above 10%. But this what is more important is to look at the risk as well. And in here, right, we can see that they have a high debt to cash flow and as well as the negative free cash flow for the most recent year. And when I look at this kind of things that are flagged out to me, right, I want to do more research on these particular items. Okay, and this is whereby the financials tab will come into use. Okay, but first let us go through bit by bit. Okay, first thing is the revenue and net profits. Okay, let me just go to 6 periods. Sorry, let me go 5. Okay, let me zoom in slightly. Okay, they have demonstrated a steady increase in revenue, okay, over the past 5 years, 2015 to 2019, 328 to $388 million. Okay, net profits. Net profits is more dramatic. Okay, you can see they are loss making in 2015. Okay, due to the write-off of the cafe Benny, the one that's selling bingsu, okay, the Korean bingsu and things like that. So they actually suffered a major loss over there, and then subsequently they have a lot of cost-cutting measures, and it resulted in the profits increasing to 34.6 millions over the years. Okay, and you can see from here that their profit margin last time was around, okay, maybe like you can say that it's negative or 0%, and then as they implement their cost cutting measures to streamline their business, their net profit actually went up, and right now it's 9%. It's the highest over a decade, over 10 years. Okay, then going to the dividends per share. Okay, let me also look at it from 2015. Okay, so 2014 and 2015, they are sort of like making losses or just nice break even on 2015. That's why they didn't pay out any dividends. But after that year, right, onwards, since 2016, they have been paying an increased dividends, okay, over the past 4 years. So they actually even pay out a special dividend last financial year, 2019. And if you look at their dividend payout ratio, it's very manageable. Okay, just 15%. Okay, 15% payout ratio. That means what this payout ratio means is that you earn $1, right? For 15% payout ratio, you're just paying out 15 cents out of this $1 to shareholders, and you are retaining the balance 85 cents to sort of grow your business. And this is what they are doing, which I will highlight on the growth prospects later on. Okay, moving on to the ownership portion. I like to look at companies with the high C-suite ownership, so that they are well aligned with shareholders. And from here, right, we can see four major shareholders, four top shareholders, which are worth mentioning. The first one is Salim Anthony. Okay, for those who don't know this man, right, he is actually the boss or the CEO of Indo Food, which also manufacture the popular Maggi mee called the Indomie. Yeah, so his company is listed in Indonesia, and for him, right, this is his own personal stake. He owns for 24.5% in Food Empire, and because he also owns a so-called like a food manufacturing company, right? He will also bring about this kind of experience, or just a vote of confidence that okay, I think that Food Empire has a chance to become like Indo Food in future. Okay, then moving on, the chairman, right, is actually Mr. Tan Wang Yao. Okay, and Madam Tan Kwek Ming, right, is the chairman's wife. So collectively, 12.69 plus 9.7 is around 22.4%. So the chairman and his wife owns a collective 22.4%. With the CEO, Mr. Nair Sudeep, okay, owns around 11.4%. Okay, and that's for the ownership. Next up, we will also go back to the valuation as well. Okay, let me go to maybe just 6 years. Okay, because of the losses in 2014 and the nearly break-even point in 2015, right? Their P ratio is sky high, 450 times. However, if you like take a look at the numbers here, right? Their P ratio currently stands at around 8.2 times. Is one of the lowest across a 10 years period. Okay. With that, we also want to look at the analyst consensus. Okay, currently there are two analysts covering Food Empire. Okay, they have a average buy recommendation. Our average target price is 68 cents, and that translates to around a 27.5% upside for Empire. Okay, with that, we move on to the growth prospects for Empire. Okay. Okay, there are three main portions of their growth prospects. The first one, like I mentioned, right, their net margins have been increasing across the years due to their streamlining of operations. So what they're trying to do is to enhance the operational efficiency by closing down all the non-performing ones. And one of it, right, one example is that they decided to cease the Myanmar operations due to two main reasons. The first one is that the Myanmar currency called kyat, yeah, it has depreciated sharply against the USD over the past 2 years. Okay, and the instant coffee market there is highly competitive. The other coffee players, one of it like Nestle, right, have not raised their selling prices, and because they have you know, the holdings, the cash bar to sustain over a long-term period, and it results in a very difficult and challenging operation side for Myanmar market, and as a result, right, they decided to pull out of Myanmar, and this one will allow the group to direct more resources to develop their core businesses in other markets. Okay, the second point, which is the second instant coffee plant in India. So they actually this second coffee plant, right, in India is scheduled for completion, and production will start around middle of financial year 2020. However, due to COVID-19, there is some delays, okay, because they will require the original equipment manufacturing OEM, so called the suppliers, to come and test out the plant and commission the plant. But okay, this is still in the works. Once it kicks off, they already have a first coffee plant in India, so the second one will just sort of like increase more of the goods being sold. Same thing goes for the non-dairy creamer plant in Malaysia. Okay, they following the success, right, of their first Malaysia plant, the NDC so called plant, right. the group has plans to commence the construction of a second one on its existing plot of land. So this construction, right, will leverage on the existing infrastructure and resources. So this will possibly take place at a much faster pace and be ready in 2 years' time. Okay, the overview of Food Empire. Financials is that they have a steady increase in revenue and net profits over the past 5 years. Okay, the net margins have been trending up. Okay, from the break even in 2015 to 5%, 6%, then to 9% in FY 2019, and it's actually the highest over a decade. Okay, dividends per share. Similarly, after they started making profits, they have been increasing the dividends per share. And like I shared just now, the payout ratio is around 15 to 22%. It's very manageable, and there may be room for higher dividends as well. Sorry. Okay, the ownership portion, right? The chairman and wife owns 22.4%, CEO owns 11.4%. And like I mentioned, the Indo Food CEO, he owns around a 24.5% personal stake. Okay, then for the valuation portion, the P ratio of 8.2 times is one of the lowest across a 10 years period. Okay, the analyst consensus from two analyst ratings, right, and translate to around a 27% upside. Okay, then last but not least, their growth prospects and risks. The operations, they've been trying to improve their operational efficiency, okay, by pulling out or closing down the non-profitable ones. Second, coffee plant in India. Second, non-dairy creamer plant in Malaysia. Okay, and then I'd like to just also touch on the risk. Although there are a lot of positives about this company, we also need to be wary of the risk. One of the major risks, right, is actually the currency FX fluctuation. Okay, because their core markets, they have started the marketing their products in Russia and Eastern Europe, which is like Ukraine and all that, right? From the beginning. So even though they are trying to diversify away into the Vietnam market and things like that, the Russia and the Eastern Europe remains as one of their core markets, and any currency FX fluctuation, right, will impact on their net profits. And one case in point is that the Russian ruble, okay, actually depreciated sharply during the oil crisis, because Russia depends a lot on selling of oil. So when the oil prices collapse, right, the RRB, the currency also depreciated. Okay, and another point to note is that for all these food manufacturers, right, there is bound to be a stiff competition with much more bigger, larger food producers like Nestle, Unilever, who have a lot more like war chests to fight marketing campaigns and things like that. So these are the two major risks that investors should take note as well.